we are excited in a good way, in the sense that as anything in this world, one needs a break from time to time. And we have done so many webinars this year, I think so many hours of Zoom, that this is definitely the last webinar of 2023 from our firm. We will obviously be looking at doing a full range of webinars again in 2024. So we are very, very excited because this will be our last topic, and very important one. And we are happy, and we will be looking forward to receiving any suggestion on topics. So anyone who wants to suggest any type of topics to us on what they want to hear, feel free to message us, and we will include it, as we are just now coming up with our full range of topics. So let us start with our webinar for today, which is about end of the year transfer pricing tips for Malaysian taxpayers. And I think the reason why we choose this topic is because if majority of companies financial year end is this 31st December 2000 or 31st December 2023, now is the time to start thinking about whether the taxpayer needs to do any adjustments on the price agreed in control transactions, and what to do about it. So hopefully from today you get some tips around what to consider when it comes to year end, because in my view, that's the most crucial timing to think about any type of transfer pricing adjustments, because in my experience is probably the cleaner way to do adjustments in general. Once the company closes the books and starts looking into audit and the company tax return, it will be harder to do any adjustments. Now, with the changes in the e-tax guide in Malaysia that were enacted in May 2023, I think this aspect of looking at year-end adjustments is even more important, because of the fact that now we have a narrower range in Malaysia. Before we get into the detail, for those who are new, let me just give a brief introduction about our firm. We specialize in offering transfer pricing advisory services to multinational companies in the Asia Pacific region. We have 4 offices: Australia, Singapore, Malaysia, and UAE. From those offices, we basically cater to multinationals in the region. We also, as some of you may know, we do participate in different industry journals, and we also participate in different places and arenas, always talking about transfer pricing and international tax, and sharing what we know, and educating, particularly because it's such a specialized part of international tax that it comes down to practice and to experience. So we have today our recurrent speaker, which is Hon Chuan, our director and technical lead in Malaysia, who has more than 10 years of experience in transfer pricing and indirect tax, assisting companies across different industries with transfer pricing planning, risk management, transfer pricing documentation, country by country reporting, among others. He's making a huge effort today, which we are lucky to have him, because he has a little bit of a throat pain, as a lot of us do, because we are kind of in flu season, but nevertheless, he's eager enough to be here with us today. And for those who don't know me, my name is Adriana Calderon. I'm the technical lead of our Asia Pacific business, co-founder of Transfer Pricing Solutions Asia and Malaysia, with more than 15 years of experience advising multinational companies in the area of transfer pricing. Prior to that, doing domestic and international tax as well. So I think between Honchuan and myself, we have probably covered almost any type of transaction that a multinational group enters into, and hopefully we can give some insights and bring our experience today. So with that, let us just go through three key things that we're going to talk about it today. Number one is Honchen will talk a little bit about the operational cycle of transfer pricing and why is it relevant when it comes to adjustments and audits. I will talk about the type of transfer pricing adjustments that one can have available. And then Hunchuan will talk about some tips about being audit ready and what to consider when it comes to year end. So maybe with that, Hunchan, I let you get started with the operational cycle of TP and what is the importance when it comes to adjustments.
Thanks, Adriana. Um, Thanks for joining us. Um, yeah, I guess even though we put this, year-end tips, but I think it's crucial that we know about the TP cycles. I'm actually an advocate of these TP cycles. I'm not sure about you, Adriana. I'm not sure whether you said that. Was it last year when we've gone through this that you're not looking to TP cycles in general? But for myself, I really look into ensuring that taxpayers should follow the right approach, the TP cycles that we have put up here, and based on my observation this year, especially where I can see there are a lot of taxpayers that are really looking into TP and really stepping up, and I'm talking about Malaysia, really stepping up to actually have a TP planning in place, as well as getting their policies in place, right? Because I think it's a good thing to have a policy to, like the SOP for manufacturing, right? You have a policy for all the employees to adhere to. So it's good that when we look at TP cycles, it's not about step by step approach. The very first thing that could make this happen would be to have a good governance internally, right? So that's really important because I understand the pain that some taxpayers may have when there is a misalignment in vision from the person in charge, for example, in charge of TP versus the management or the board of directors, for example, where the person in charge wanted to have all these things in place, right? All the good governance, the planning, the policies. But unfortunately, then you have the management where you have constraint where they would stop you from having that done because having good governance may come at a cost where management may not see it as a valuable addition to the costs that they have. So which means that um, they may have everything correct, but if you do not have a good governance, it may not have everything to flow through the cycles itself. So yeah, for taxpayers, it's really good to have a communication with your management to actually sort of educate them to say that hey, TP is not just a compliance, but it's more so to ensure that from start to the end, if everything is done correctly, then your investment in it will make more sense at the end, right? Because they may not look at it that way, right? So it's good to then educate the key stakeholders within the group to have a proper governance in place. Now, when usually when managing TP, a lot of companies focus on the compliance work, right, which is almost at the end. But actually, with the TP cycles, the actual preparation for the reviews or audits, right, it actually comes straight from the start, right? When the company has a view or developing any kind of related party transactions or arrangements, you should then by right start from there, right? Then when you follow through, then it may make more sense instead of treating it as though you've gone through the cycle. Only then you're looking into TP. Um, but at the end of the day, it may not work out. So it's always good to start from the start. So it's really crucial to have this awareness and understanding that TP is a risk that need to be managed. And if you look at recent developments by the RRB, where they introduced increased penalties, decreased turnover time, surcharges, for example, all these shows that the tax authorities are actually scrutinizing TP on a different level as opposed to previous years, especially COVID, where COVID times is where the economy crisis and the government is actually helping taxpayers. Now the government will get the taxpayer to help them back, right? So now, so the best way to go through your TP arrangement is actually to go through the TP cycles here um, in the diagram, where we have planning and policies first, right? That goes to price setting and contracts. Then after price setting, you have then your transactions and your journal entries applying what in theory it is. And then after which testing what you have applied. And then you have your monitoring where you have that governance in place to monitor all this are in action. And then lastly, if it comes to that stage, controversy and litigation, where if you have all these TP cycles in place, you shouldn't be worried about the litigation or this itself. So these are TP cycles that we will look more detail in later sections.
So, what would be your view on what to consider when you're planning and setting up a policy? So, let's say that today a company has decided to enter into a transaction. So, what would be your first step when it comes to um, planning the implementation of that transaction? I guess.
And yeah, I really emphasize in planning and policies, right? So to me, TP planning is really the key to make everything work, right? So as you expected, the first place is planning and policies, where ideally is where the process should commence. A TP policy is put in place which sets out the group's TP framework, right? So obviously when the taxpayer comes in, you would have no idea what's going on with TP. Now, with planning and policies in place, it provides the taxpayers that framework. It's not just for the person in charge, it's for the overall group to understand what TP is, what's within the policy itself, what transactions are in there, right? So a few questions comes in mind, right? Like for example, what is the company's approach in TP in general, and who is actually responsible for the TP within the group itself. It's good to have someone to be in charge of TP to ensure that you have your governance in place to ensure that um, the planning stage you have a local or regional person in charge to be accountable in relation to the TP itself, right? And then obviously the next question would be your arm's length standard. What, how is that applied? So in this case, then obviously then you have this where your the benchmarking analysis, your searches or any other methods to be used to come up with the arm's length pricing, right? Then lastly would be whether it aligns with your business model and overall strategy of the business. We need to understand, and taxpayers need to understand that we are not following the TP rules. We are looking at TP rules as a guidance, right? The business does not work around TP, right? You would have your own business model and your own strategy of business, um, and that TP actually complements the business strategy to ensure that your business strategy is actually um, at least within the purview of the TP rules and regulations, ensure that it's at arm's length um, as well, right? So that's important to ensure that you have your management transfer pricing versus your tax transfer pricing, whether it aligns together or not, right? So yeah. So lastly, yeah, I would like to emphasize that planning is crucial because if your group TP framework is done properly, everything should fall in place. So this framework itself, it will cover the flow of your TP transaction, and if it's there and implemented accordingly, then you shouldn't have need to worry. And here, communication is key. As I mentioned earlier, it's not just a one-man job, one person that in charge with TP, and the person will just get everything done. The person you have a person in charge, but the person in charge will actually disseminate these information to ensure that you have a framework in place. Almost all the key stakeholders in the group would understand that TP framework and would actually adhere to that TP framework itself, right? And lies the importance of it. Any music?
So I have a delay in my slides as
Okay,
usual.
that's fine.
So what will be some of your key tips when it comes to, okay, so you're already saying that if I'm going to enter into a transaction, if I hear correctly, what you're saying is, okay, just do a proper planning and set up a TP policy. So what would you consider that is key within that TP policy? And apart from that TP policy, what else would you consider to have to back up that policy?
Yeah. So when you have TP policy, a framework in place, right? The next step, which is really important, is actually to get the price setting and more importantly the contracts correct. Now I need to also again emphasize that contracts are almost a must. It is not spelled out in the guidelines, but if you look at the new TP rules, right, it has a certain section within the TP rules, not sure which paragraph, where it states that taxpayers need to ensure that all the documents listed in the section should be available, right? Contracts is one of them. And if it's not available, why is it not available? Right? That's one thing. Second thing is during an audit, the contracts will be, in addition to the TP documentation, will almost 100% be requested by the RB. Right? That's their first point on the contract. They ask for TP documentation, they ask for your contract straight away. Right? So contract is very important and you should actually get that formalized. So in this phase, once you have the TP framework in place, you're actually setting the price. And then once you've done that, you have actually then dealing into your contracts. And these contracts should have all the details of your related party transactions. And it should then be formalized, meaning that both parties who have gone through that contract would have agreed upon the terms and conditions within the contract and then would have signed the contract itself, right? That shows that it provides an evidence to the RIB that a discussion has been in place, a meeting has been in place in relation to the setup of this related party transactions, right? Which will also then be requested by the RIB. They want to look at emails or evidence that shows minutes of meetings, for example, to show that you have gone through the process. You have both formalized contracts. Both entities have both formalized contracts, and those contracts are valid and in place. And lastly, the contract is not just a document that's being signed and then just left it in one place, right? It should again still be reviewed annually to assess whether and there are any changes to the terms and conditions of the real pie transactions. Um, if there is, then it should then be amended to the latest date so that your contracts remain contemporaneous, right? As again with reflecting the TB documentation itself.
I have a question here, which we haven't rehearsed, by the way, is uh,
Yeah,
so when we talk to contracts,
yeah,
right? There is a general understanding. Okay, one thing that we always face is people not understanding or companies thinking that a contract is not necessary when it comes to intercompany transactions. So I think we have clarified already that that's actually a myth. You do need a contract because you are actually simulating a third party scenario. So you wouldn't do nothing for anyone if you don't have a contract. The third question is, can I just use a third party template contract for my intercompany contract?
as in just use exactly identical with the third party contract
Yeah,
with your
exactly.
related party. That
Kara, what's your opinion on that?
most likely not, right? Because I mean, unless they are both identical in you still will not be able to use a third party anyway, right? The third party is in relation to the third party, and the contracts or terms and conditions or arrangements that you have with the related party would most likely not be the same with the third party, right?
Mm.
I mean, even the the recipient or service provider will be different anyway.
Yeah, but I agree with you. The reason I asked that question is because a lot of the times I see, well, okay, finally, in the hope that the company decide to put the contract, then they put the contract in place. And then when you read about it, it has a lot of clauses that are irrelevant, but the ones that are relevant are not there. So that's where, yeah, the contract is important, but also some minimum um clauses around what is important for transfer pricing point of view, which to some extent is the price and the responsibilities and some of the risk associated with that transaction, some of the activities associated with that transaction. Because if you actually don't address it, so I come back to the point of like a typical example, if a contract manufacturer. So I remember having a case where we were given the contract manufacturer agreement and it looked very much like a third party contract that was saved as and created. And then obviously when you have a contract manufacturer and you have a lot of experience doing TP, the first thing you look is what's the risks? What's the assumption of risk for the contract manufacturer? And then you see in the clause straight away that the contract manufacturer is responsible for the warranty or and the product liability or warranty liability of the product. Then straight away you realize, well, if you provide this to IRB is going to tell you, no, this is not a contract manufacturer. This is a full manufacturer because in the contract it says that it's assuming the responsibility in front of the third party customer of the manufacturing um, default or faulty products or what is called warranty liability,
Mm.
which in transfer pricing world should not be assumed by the contract manufacturer. And that's only one example of the many situations that I have found that, yeah, they are great, but they don't address the key points. I don't know if you have faced that also.
I think it's good that you actually point that out because that happens a lot actually. The tax authority will scrutinize your contracts, right? They actually, it happens a lot in audit, and they actually use your contracts against you because you thought you have everything in place, but actually you actually didn't really read your contracts um, in detail, and tax authorities will look in scrutinize your contracts and catch all the phrases, right, 11 once, and then get back at you. And I think that it's happened more often than previously that have used the contracts against the taxpayers.
Okay. So how about from implementation point of view, what will be some of your key tips?
Yes, implementation. I think that's something that taxpayers they I'm not sure whether they lack the experience or they they have concerns with how to implement a transaction, right? Because to me, again, I mean, the whole cycle is that obviously if you have a TP framework, that's fine. But if you do not implement it as what has mentioned as per the contract, then it wouldn't matter, right? So we have the form, which is the contracts, and now come the substance itself. Now, substance means that in actuality, whether it happened, the transaction happened or not. And in implementation phase, it's more the responsibility of the accountant to ensure that these transactions are recorded and actually invoiced and charged accordingly, right? For example, when you have a service provision by a Malaysian company to a Singapore company, the Malaysian company needs to make sure that, okay, the policy is I've got this cost, chargeable cost, plus markup percentage based on the policy. Then the accountant will to calculate the cost plus markup, which comes to the fee to be charged to Singapore, right? So then you have to actually then obviously raise an invoice to Singapore, and then obviously then this amount would then need to be recorded into the books, right, correctly. So the implementation phase, it's also important. Again, I think the whole cycle is very important, where you need to make sure that all these charges are reflects your contracts, also reflects your policy, reflects your TB documentation, to ensure that the figures in your books are the same as per your any of the disclosures in the form or TB documentation. Because when IRB comes in and when they start looking at the request for um your journals, the request for invoices, sample invoices first, and do a cross check and see whether it makes sense, whether it's RM5 versus RM5 or not. Right? If it's like RM5 here and RM4 there, straight away you raise a red flag to IRB, then they'll ask more. They ask more for more invoices, and yeah, a lot more mistakes happen. Then IRB will then start scrutinizing. Then they have the avenue to actually adjust you or provide more reasons why you should be adjusted. So in the implementation phase, really we need to make sure that the transactions are actually recorded correctly and consistent throughout all documents.
What about then now testing, compliance, monitoring, and audit? What's your
Yeah.
views first on testing and compliance?
So testing is when taxpayer comes to us and, oh, can you help us with the TP documentation, right? So that's the end part, unfortunately. So the testing part is where you have the TP documentation in place. So compliance, to have TP documentation in place, um, to have to test your transactions. So the objective of testing and compliance is to ensure that what has happened are at arm's length, right, by way of different TP methods. So the TP documentation act as a report that analyzes the group's operations, your supply chain, industry, your functions, and then obviously testing the transaction itself, whether the transaction or the policy is at arm's length. So there are methods to be used, and benchmarking can be one of them. And there are other TP methods to test um, those transaction itself. And then yeah, you have the second one where it's based on the um, head of tax saying that, oh, you should do nothing and it's no longer an option. It's even more so that they have the 14 days and we have the surcharges in place with increased penalties. Then it actually puts taxpayers in a very difficult position, right? So it's really important that you have all the above, and when it comes to testing and compliance, it shouldn't be any different when you have the TB documentation.
I think a typical question that we get asked is, okay, so if I'm testing, what's the right timing for testing? and what's the difference between testing and setting, I guess.
Yeah, yeah. So yeah, so here we have ex ante and ex post. I don't think we should be looking at ex post anymore. So ex ante is when, at the time of entering the transaction, you have everything in place. You come up with the planning, come up with your price setting to ensure that the transaction itself will be charged at arm's length. While ex post would be after the transaction has happened and that you have the actual outcome, then only then you use a method to test the actual outcome and see whether it is consistent with the arm's length principle or not.
What is the accepted approach by IRB?
Yeah, the latest um, TP rules, TP rules states that the contemporaneous is when you have your TP documentation ready by the time you launch your income tax return, right? So to me, that's a bit of a leeway, which is okay, because generally speaking, you should have it as at the time that you entered into a transaction. But obviously, the latest is when you have before you're lodging the income tax return.
So you kind of have two chances. One, when you set up the transaction, and then by the time you lodge your tax return. And that's basically the latest. But in the past, what we had was the wording of Malaysia tax guide was more about contemporaneous when the transaction was entering into.
Yeah,
And in the new tax guide, what we have is that you kind of have two chances at the time of setting and testing. Obviously, I'm assuming here that the setting is during the year and the testing, uh, meaning that we are not talking about setting 3 years back, because if it's setting 3 years back, you still have to do your testing anyway by the time you lodge your tax return. So you cannot accept something that was test or done 3 years ago as your testing.
yeah, yeah.
So it has to be basically contemporaneous, meaning for the year that
The
you
income year.
are testing, basically. Yeah. How about the importance of monitoring? Because I think one of the key questions, but I think is mainly because of lack of information. We have a lot of questions about why is this something that we need to do every year? Why do I have to do it every year?
Yeah, obviously the reason why they ask is because of the cost, right? And the problem is that the taxpayers don't understand why, and it's really important to understand that you should understand the concept of contemporaneous, meaning you need to relook at your transactions or your transfer pricing position at that income year, during that income year, whether there were any changes or not, right? So if you do not do that, if you don't do an annual review, how would you be able to assess whether um, your TP documentation is contemporaneous or not, right? Because when come the lodgement of the income tax return, you have to declare that your TP documentation is contemporaneous. And now that the tax authorities have included the date of completion, right? Completion date for your TP report, right? More or less, you need to do annual review. And yeah, so on top of that, you also need to fill in the form, right? The RPT form when you have RPT. So that's when you actually still have to look at your TP documentation. Now, I do understand that TP documentation, the initial investment is actually costly. But when you perform an annual review, barring that there's no changes to your business, there's no changes to your related party transaction policies, then it shouldn't be that costly, right? Because you still need to do an annual review. You need to look at whether anything has changed, right? You also need to re-update your financial performance. Maybe your financial performance needs to be looked at. You also need to look at whether there's any changes in the verified transactions or not. So these are the things that you need to look at and see whether there are any material changes to your TP position or not, right? And at, then lastly, you still have to test it, right? Last income year's result versus this income year's result will not be the same, right? So, and at the latest income year, you will still need to do a financial update to ensure that your policy falls within the range, especially 2023, where they have introduced a much narrowed range, right? So you really need to look at the new range to ensure that your policies should be in place, right? I mean, actually, you should be looking at like way back June, July when they introduced, because then you may need to retweak your policies if your policies does not follow the usual median or not. So these are things that you need to keep monitoring. And when I talk about good governance, this is where it falls under, where you need to ensure that all this falls back in place, ensuring that for this income year we are good. I can sign off and then tick. Directors is happy. They're not going to go to jail if there are any adjustment they make. So this is very important to ensure that you have this last phase to finish off your TP.
So actually, you bring a good point, which is the issue around 2023 onwards, which is the could be significant adjustments that will need to be performed, especially, I guess, the fact that IRB changed the range will increase the chances of companies not being able to support their transfer price based on all benchmarking. So I guess that's where it comes down to, okay, what can I do? What type of adjustments are there available for me in the context of transfer pricing? And for that, it's good to understand what is a transfer pricing adjustment. So the adjustment basically involves adjusting the price on a transaction to reach the market price of or the arm's length price agreed for the control transaction. And that can involve a true up or a true down, which is basically, in very layman terms, bringing the price up or bringing the price down to meet the market price. That will be a adjustment that is performed by the taxpayer. Now, there could be adjustments also that are triggered by audits that the tax authority conducts. So if the tax authority finds out that there is something incorrect with your pricing, or they don't agree with your market price, they can do the adjustment unilaterally as a result of an audit. So now, why would the taxpayer do the adjustment or the true up or the true down? Because they want to avoid having to go down the path of an audit, and they're doing the best governance effort possible to ensure that they can meet that market price that they believe is truly a market price. So one thing to keep in mind always with transfer pricing adjustments, that they fall within tax adjustments in general. Why? Because they have a direct impact straight away in your tax computation. So even though they are transfer pricing adjustments, I always call them tax transfer pricing adjustments because they impact your tax bill, basically. Now, let's see this example when it comes to taxpayer adjustments. So I have a company here that is located in Malaysia, Company C, that gets paid from an entrepreneur a service fee of net cost plus a markup. So let's assume that we agree by the contract that my markup is going to be 5%, which is a net cost plus markup of 5% over here. So that Malaysian entity will probably be kind of depending of what's the way in which they calculate their markup every month. they may have uh, a situation where they worked monthly invoices based on budgeted expenses. And that's maybe what they do month by month. But then let's assume that there is a variation in the budget, and maybe I have an increase or a decrease in my operating expenses. So in theory, if that happens, then probably I will have a shortfall in my markup and I will not be earning 5%. I might be earning based on actuals 4%. So the taxpayer, if he has proper governance and proper monitoring, will have to adjust to the 5% markup before closing the books at the year end to ensure that that 5% markup that was agreed with the entrepreneur in the first place is reached. Because if it's not reached and you're subject to an audit, then obviously IRB will try to adjust you to the markup that it was agreed in the contract. And the last opportunity is basically at the closing of the books. So that will be basically the scenario where I will be doing the year-end adjustments. So the idea is to do it before the closing of the books to make sure that you meet the arm's length price agreed. It is always recommended that it needs to be backed up with a TP analysis and a TP documentation. And it doesn't prevent IRB to still conduct audits and TP assessments. It's just that is the habit of having good governance to monitoring that the taxpayer reach the market price every year, because at the end of the day, IRB has 7 years to investigate whether or conduct investigations. So you can do your lodgement of your tax return now in August, and IRB still have about 7 years to come and investigate your 2022 tax return that was lodged in August or July 2023. And another thing to always watch out for is any amendments that need to be done from custom and indirect tax point of view. Then there is another avenue which is very popular these days, and there has been campaigns on in general, which is voluntary disclosures, which is the exercise of amending or doing modification to past year's tax return, again to bring your price up or your price down. You can voluntarily come forward, do a written disclosure, a written request to IRB with an estimation of what's the tax adjustment that you want to do with in the way of a form, together with the documentation and all the documents that support your claim or support your adjustment. That is done for, that is the avenue in Malaysia to do adjustments of past year's income tax return that have been filed incorrectly because of transfer pricing. Obviously, the reason why the taxpayer, if you have good governance, and the reason why you will be doing your year-end adjustments in the first place is to avoid having to do a voluntary disclosure, because you really don't know what you're going to get when you go down the path of voluntary disclosure and discussing a lot with IRB, which doesn't prevent them to conduct an audit. So that's the downside. I don't know if you have any comments on this,
Yeah,
Hunter.
just to add on that, talking about voluntary disclosures, I'm sure you guys, the taxpayers, are aware that we have the special voluntary disclosure program 2.0 that was effective June 2023, which is until May 30th of May 2024, if I'm mistaken, or 31st of April. But yeah, so they do have the SVDP in place if any taxpayers want to look at it. So that's a 2.0 one.
Okay. So, as I was saying earlier, if the tax authority make an adjustment because they believe that the um, price is not an arm's length, that then the tax adjustment will come out of the TP audit. So, um, let us talk a little bit about the penalties and some of the penalties around adjustments, Honchuan, when
Yeah.
it comes to tax adjustments. So these are penalties that happen when there is tax adjustment, just to be super clear, because when there is true ups and true downs, true, and that's a big difference. When you do true ups or true downs before closing your books, that is not subject to any penalty. That's a, how can I put it? That's a, I don't know if I call it a right, but that's actually a normal course of action that a taxpayer is allowed to do so without any penalties, which is the act of adjusting your price to fall within the agreed arm's length price. Tax audit, tax authority adjustments, in the other hand, which come as a result of audit, they are subject to penalties, which are which one?
Yeah. Yeah. So actually, to go back the adjustment part, right? The audit adjustments. So last time, well, pre 2023 rules, there is a paragraph in relation to the offsetting adjustment, corresponding adjustments, where especially for the Malaysian domestic transaction, where if they adjust one Malaysian entity upwards, then automatically then the corresponding entity will be adjusted downwards. But then now they have taken off that paragraph, which means that that may not apply. So if the tax authorities adjusted the Malaysian entity upwards, right, the other corresponding entity will not be adjusted downwards, right? I mean, there may be appeal or something you can do, but now it's not automatic. So bear that in mind. Now, in relation to penalties, yeah. So I guess the penalties for Malaysia is obviously when we talk about the 14 days um, to furnish the TB documentation, and if you fail to finish that TB documentation, then your penalty is actually 20,000 to 100,000, and or 6 months of jail terms, and then you have your penalties in this table where if under audit case you have 50%, you have not have the TB documentation in place, and if you have TB documentation in place but not in accordance with the TP rules, sorry, it'll be 30%. Then obviously the last one, which rarely seen, is 0% if it's done correctly. If you have done correctly, I doubt there should be any avenue to adjust. And on the right column, voluntary disclosure case, that's only if also for a previous case, a little bit different if we participate in the SVDP 2.0. So they have a separate case, which is, I think, more or less zero. So, and on top of all these penalties, right, during audit, if there will be a 5% surcharge, regardless of whether you have tax losses or any losses, that it still applies. That 5% surcharge will still apply.
Okay. So what would be your, before we start looking at the questions, what will be your audit ready and end year tips?
Follow the TP cycles.
Yeah.
Yeah.
If
So I
we
guess
look at it in the form of an example, I guess.
let's look at the examples, right? So here we have Singapore selling products to Malaysia um, as a distribution company, and it's like industrial parks.
Yeah.
So the questions are, when you look at this simplified um, transactions, now what are the common areas of disputes, right? It may look simple, but there are actually a lot of things that you can actually scrutinize. Where first up would be characterization of the respective companies, whether they are, in this case, distribution or not, or whether to what extent the risks of the distributor is. You have your limited risks, routine, full-fledged distribution, right? These are the one of the common disputes where the RBA come in and see whether you have characterized that correctly or not. And then obviously looking at the price itself, right? When it's being sold to Malaysia, is that price correct, right? What's the pricing policy in relation to that transaction itself? And then when we have very common one would be, as a distributor, is the Malaysian company a recurrent loss maker, like a consecutively loss making, right? In normal business world, right? If a company has been loss making for more than 3 years, for example, you wouldn't be in business. So why is company B still loss making, for example, right? These are the things that we were looking at, like loss makers. Then in relation to benchmarking, for example, whether you have chose the correct local comparables in Malaysia, whether you have chosen Malaysian comparables to test against company B's margin. And then for nowadays, with the introduction of the rules, we have a narrowed range now. So you have to be in mind that previously it was more looking at median, but now does company B stays within that narrowed range or not? That still con still is a M strength range. So for RB's point of view, if you're within that range, that's fine. You no longer need to be at median, right? And then obviously, lastly, then whether any TB adjustments were made, and but were they made correctly or not?
Yeah, and I guess the last option to potentially look at those adjustments is before the closing of the year for company B to make sure that whatever price the company B is paying to Singapore is in accordance with whatever it was agreed in the contract, and that's the final number that is being reached. So I think we have spoken a lot about like just the common areas of disputes, but we always kind of group them. I think you already talked about it, but
Yeah,
just to summarize, just for information, I think you already talked about the lack of substance, incorrect pricing, recurring loss makings, comparables, what's the point in the range, and what's the potential TP adjustments that one can do. So, in your view, we have just to summarize what's some of the information to keep ready when it comes to being audit ready.
yeah. I guess this list is not, there's no hierarchy in this, I guess. So why TP documentation is number three, but yeah. So main one is TP documentation, then contracts, then invoices, your journal entries, then your org charts. Obviously, depending on the org chart, it should be in the TP documentation, and job description should be in the TP documentation, but obviously that's for cross-check purposes. And then obviously you have your support in relation to your price setting and basis for that pricing for that particular verify transaction. So the main thing that they ask generally would be your contracts, TB documentation, invoices, and if they find discrepancy, then they'll ask further on your emails, correspondences, to double check that the existence of services, for example, right? You have stake in substance wise. They want to know that whether that these type of transaction exists or not. So these are the common documents that are being requested by RB. And yeah, so key takeaways. I think for me, the key takeaways is actually go through the whole cycle. If you if it, if you see how I explain it, it it really falls up to the framework. If you have a good framework and the governance as well, everything applies correctly. By the time that you're testing it, you're actually testing what you have planned anyway, right? That makes things a lot easier, right? You don't have a worry that, unless obviously that your TV planning is done incorrectly, which should be done correctly, then by the time you're testing it, you shouldn't have any worry about, audit or not, right? That's how you get audit ready, right? Not get everything done, then see what are the tips to be audit ready. But the cycles is the major tip to be audit ready. What do you think, Adriana, in terms of audit ready and year-end tips?
Yeah, I think my experience has been the same that if there is bad governance and bad planning, that decreases the chances of being able to defend the company during audit. And it becomes quite a headache, I think, because the company doesn't even know where to start to explain. So I think I do agree with you on that. So let's look at some of the questions that we have. Mm, the first one is, what's your opinion regarding multinational using a generic contract in various jurisdictions? One contract, same wording, same terms and conditions being used for many entities in different jurisdictions. I don't have an issue as long as the profiles of the parties involved is the same. In fact, some companies will do that to standardize a bit the number of documents that you need to use to support transactions. There might be some difference country to country depending of, if you have to put GST or VAT or etc. But if the profiles of the parties involved is the same, I don't necessarily have any opposition on using them. What's your take?
Yeah, I think I agree that I think you need to really assess that and to make sure that that particular transaction, all parties actually adhere to the same terms and conditions, same policy. That's fine.
The second question is an interesting one because under TP Rules 2023, we have 6 months to complete TP Doc. Would we have enough time to get the 2023 audit report of comparables from Companies Commission of Malaysia for the benchmarking exercise?
Yeah. Hey, this is one of the frequent questions as well. But rest assured that the tax authority, they do understand that there's a lag, there's a time lag in financial statements, right? You actually do not need to use the latest. I mean, you actually don't need to use the 2023, but you have to use the latest financial statements available when you are preparing and completing the documentation, right? The tax authorities do know that there's a time lag.
Mm.
So
I agree with that. Like, I mean, depending on the time, when you're doing it, it has to be the latest, right? Uh, Someone is asking a clarification. What do you mean by profile of the company are the same? I'm talking about characterization, functional profile. That's what I'm talking about. And there is one more, which is examples of amendments required on indirect tax. I think if there is a sales tax in the context of Malaysia being required in the invoices associated with the related party transaction, then that's the indirect tax that you will be looking at. I think that's pretty much it. So, Honchan, how does it feel to be done with all webinars in 2023?
are you falling sick as well? It sounds like you're falling sick as well.
Well, I was, remember, last week I was a little
Yeah.
bit
Yeah.
just recording. So, if everyone can follow us and subscribe to our YouTube channel, that would be awesome. We have a lot of content there. If anyone has any topics that they want us to cover, that would be great. Also, our details are over here for our Malaysian office, and we look forward to come back again, recharge and refresh for 2024, isn't it, Hunchan?
Yeah.
Seems like calls are getting the better out of both of us.
Yeah. Yeah. Yeah.
Thank you.
Thanks a lot, Adriana. Thanks.
Speak soon.
Thanks.